Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is serial entrepreneur and real estate investment expert Matt Buchalski. Now, Matt began investing in real estate back in 2016, owning a portfolio of multifamily and storage assets across Texas. Now, he's the co founder of Take Flyte Properties, Take Flyte Capital, and Deep Blue Capital, and has extensive experience underwriting and optimizing underperforming assets. Now, additionally, Matt has built and scaled multiple sales organizations from the ground up with a deep expertise in financial services and software verticals. And so, guys, without further ado, I'd like to welcome Matt Buchalski to the show. My friend, how you doing today?
I'm doing awesome, Kevin. Thanks for having me on the
Yeah,
show. Appreciate it.
excited to
I'm
have you
excited.
here. Absolutely excited to have you here. Excited to talk shop with you, get an understanding of who you are, what you do. I know we were chatting a little bit before the show. I know your background is and what you do is much more extensive than that short introduction that I provided for you. And so, Matt, for those that aren't familiar with you and your story, maybe take a few minutes, tell us who you are, your background, and how you found your way into real estate.
Sure. Happy to do so, Kevin. So I am a lifelong seller. I've been in sales pretty much since the week after I got out of high school, and I absolutely love it. At some point in my sales career, I took an opportunity to move into sales management, ultimately sales leadership, and I've had the very fortunate opportunities to build several sales teams from the ground up
Mhm.
and get a lot of fulfillment out of finding and hiring and developing salespeople that go on to make themselves and their clients a lot of money. Right around, the mid 2010s, call it 2015, I started to really kind of get the itch to find ways to create other sources of income. And on a fishing trip, I asked a buddy of mine who at the time owned like 50 single family homes out in the east end of Long Island what he did and how he did it. And we spent the vast majority of the trip talking about his techniques, the neighborhoods he invests in, his mistakes and opportunities, and how he was looking to grow. And I was super excited about it. And at the end of the trip, he said, if you're interested in taking a step, let me know. I got friends in the business, and I took him up on that offer. I ended up buying my first single family house a few months after that fishing trip. I just sold that property last year, but once I got that property stabilized and had a tenant in it, I realized that this was something I had a lot of energy for, a lot of passion about, and figured out ways to do it without disrupting my W-2.
Mhm.
And since then, I've had the amazing opportunity to scale up the portfolio, diversify the asset types that I've invested in and managed in, and continue to have a passion for it and continue looking to grow the business. So it's been quite a journey.
Awesome. No, I appreciate that background. So I'm always curious to know, what the pivotal period of time was. I mean, you talked about the fishing trip. So like that's when the idea or the light bulb initially went off. You bought that first rental property, and that's kind of like laying the foundation, laying the groundwork. But ultimately, let's talk about that first one and then what it looked like going from that point to where we're at today, like what that evolutionary stage looked like.
Yeah. So the first one was definitely a little. It's where I really kind of had to overcome a lot of my limiting beliefs, right? You think about going to invest in real estate, where are you going to find the money? That wasn't really a concern. I was doing very well at the time. How am I going to live in Texas and manage a property in New York? How am I going to live in Texas and make sure that I was getting paid every month? How was I going to live in Texas and really just handle and manage a property that was, 1,800 miles away, 1,500 miles away, whatever. And so I was introduced to a realtor that knew the area, had other assets in the area, knew the area very well. I also realized that my best friend lived like 35 minutes away from this property I was going to buy. And he was a licensed electrician, still is a licensed electrician. He was also a super handy guy. And I called him up and I said, dude, I'm thinking about making a move into this. Would you be willing to help me if something went wrong? And he's like, of course. And then I realized, my mom lived like an hour plus away, and my sister lived a half hour plus away. So, worst case scenario, I knew I had people I could trust that could kind of
Yeah.
swoop in and help me out. The next piece was, how am I going to make sure I get paid? And my buddy Pete, who's still a great mentor of mine, he's the guy from the fishing trip that I mentioned
Hmm.
before. He only did Section 8 rentals,
Okay.
right? And I kind of had to get over some of the taboo and stuff about Section 8 rentals. But what he said, what really resonated, he's like, you get paid on the first. He's like, it's not glamorous, but you're going to get paid in full on the first. So then I yanked that limiting belief off the table. So now I had the management and the payment off. And I'm like, I'm just going to do this. And so I bought it in April, had did some minimal turn, had the tenant in there by June, and she stayed for like 4 years.
Wow.
And it was great, right? First paid in full on the first of every month through Section 8 program in New York. And once I figured out that it could be done and I could do it from 1,500 miles away, I said to myself, okay, how do I take that formula and replicate it here in Texas? So I bought my second in July of 2016, so 90 days after I bought my first one. And then, 6 months after that, I ended up getting involved in my first multifamily. But for me, it was just the process, the mental process of identifying the limiting beliefs that would hold me back from doing it, figuring out how I could very tactically and very specifically overcome those limiting beliefs.
Hmm.
And then once I had those behaviors and patterns and strategies down, how do I go replicate it? And it's been a fantastic run.
Yeah, no, it's great. I appreciate that background. And I was surprised to hear. I mean, it makes sense because your buddy Pete was obviously from New York. It sounds like, are you originally from New York? Were you born and raised there?
I am. Yes, I
Okay.
moved down to
Okay.
Texas
So
about
you
10
so
years
you
ago.
say you have a familiarity with the area, right? Like there's a comfortability that goes along with it. You might not live there; it's far away, but like again, you've got a network there to a certain degree, which gave you that level of comfort. Um, I'm curious to know whether or not you continued with the Section 8 path once you bought that second property, and even the first multifamily there in Texas.
Yes, and as a matter of fact, I still have a significant portion of my portfolio that has Section 8 tenants in it, residents, I should say. Section 8 got us through COVID. I'll put it to you that way, right? I
Hmm.
mean, you hear all the horror stories about rent moratoriums during COVID, and people didn't have to pay their rent. At the time of COVID, we had a much smaller portfolio then than we do now, but I think 60 or 70% of our portfolio had Section 8 residents in it, and those checks never stopped,
Yeah.
right? And so when you go into a month and you know that your mortgage is paid, your mortgages are paid, your CapEx reserves are fulfilled, and all your expenses are covered just from Section 8, right? The market tenants that had to slow pay for whatever reason, it was just icing on the cake anyway. Plus, I really do believe that giving folks that are less fortunate than I've been in life a very clean, safe place to live, there's some nobility in that,
Yeah.
and it continues to fuel my fire.
Let's go down that Section 8 rabbit hole a little bit. Would love to get an understanding, at least in the beginning, kind of some of your limiting beliefs as it related to the Section 8 program. What were they? And then, I guess what's reality? What ultimately did you determine was reality after the fact, after you dove in and bought that first property, got your first Section 8 tenant in there, the checks started coming in, what have you. But maybe let's talk about some of those initial limiting beliefs. What were they?
Yeah, a lot of people tried to talk me out of it because of the quality of the resident,
Hmm.
right? And what they're only saying half of that equation. Me as the owner or us as the landlord, we're still the ones that end up deciding
Yeah.
who lives in our place,
Hmm.
right? And so I would personally, for a long time, go meet anyone, do the tours myself. And I was really looking for, we had mostly single moms, still do, right? Single moms that had kids and wanted to be on a tree-lined street and so there was some taboo around the tenant profile, right? And there's a lot of taboo around the inspections. Section 8 inspections are so daunting and you never pass and so on and so forth. I got news for you. The only two times I ever failed the Section 8 inspection was because the GFCI in the kitchen wasn't working, right? If you have windows that stay up and windows that lock and your doors work and your place is painted and it's habitable and your light fixtures have enclosures and your GFCIs work, like your inspection is nothing. And so I think there's a tendency to kind of blow certain things out of proportion.
Hmm.
Once I realized that I could control who ultimately lived in the unit, uh, and got the requirements down for the inspection, it was rinse and repeat.
I think where a lot of the and I agree with everything stated. I think where a lot of the misconception comes into play is at the end of the day, it's still very important to have your property located in the right neighborhoods, in the right
Hmm.
areas, right school districts, right? If you're on
Yeah.
the wrong side of the track, wrong part of town, high crime, not a lot of job opportunities, just basically the place where not most single moms or single moms with kids want to live, right? They don't want to raise their children there. And so like you basically like your tenant pool is not like you're just never going to hit the quality that you want. And I think that's you find section eights are in all kinds of neighborhoods. They're not just in that type of low end neighborhood. They're also I've interviewed folks over the years that actually took the quite opposite approach. They actually had maybe not white collar per se, but definitely higher end, higher echelon quality homes in the best school districts. That was kind of their MO, like the best school districts. The homes that were in the median home prices, everything was a 3-2 with a garage, right? Like they had this buy box, and that really worked for them. But it allowed them to filter out the folks that they really didn't want that weren't a good fit, just like we do with any
Hmm.
prospects, right? Like we have our tenant criteria, and they have to pass it, whether they're Section 8 or they're not, and ultimately allowed them to to find the best of the batch because there's really good folks that just need a a leg up in the world, right? They need an opportunity to live in a safe place, to raise their kids in a safe place, send them to good schools, and just need a little bit of help doing so. They don't want to live in the wrong part of town. So I do think that a lot of the misconception truly revolves around just thinking that all Section 8 is truly low, not low income, but low quality housing is a better way to put it. I think
Hmm.
most folks really have that perception that it's low quality housing. So, did you find, and I don't know how many different counties you've worked in, but I have noticed a difference over the years that the Section 8 program, while it has, basically the same parameters state to state, county to county, some of those Section 8 offices are a little bit more lax than others, sometimes in a good way for a landlord, sometimes in a bad way, right? Just, but have you noticed any major differences between the Section 8 housing program as you move from, call it New York to Texas?
No, I really haven't.
Okay.
I would say that one of the most important things is in any part of real estate is relationships,
Hmm.
right? And the more professional you communicate with the caseworkers inside of a housing program, the more they're going to be responsive to you, right?
Yeah.
Or what I think where you were going before, Kevin, is, there were definitely some owners, landlords out there that, don't treat their residents very well. Maybe don't treat their properties very, very well. And maybe
Yeah.
they aren't responsive, right? And I think the more you come across as a business person who is responsive and attentive to paperwork, attention to detail, send the right paperwork in the first time, make sure it's complete, make sure that all your addendums are in order and stuff. They start to remember you, and then it just makes it easier to deal with, right?
Hmm.
And most of our Section 8 stuff now is either in Dallas County or Tarrant County. And then you start to get to know the inspectors, right? And the inspectors will come in and they've seen your face a few times and they're like, hey, listen, I'm going to pass you, but fix that light bulb and send me a picture when you're done, right? And
Yeah.
and
Yep.
and so I think the relationship piece is more so than anything. Dealing with a quote unquote agency is always very intimidating and very cold. Building relationships with the people inside those agencies has been, a critical success criteria for us.
Yep. What have you seen? Obviously the last couple of years, maybe not the last year and a half or so, but prior to that, really your 2020, 2021, 2022, we saw just a massive run up in rental rates across the country, really, in most markets across the country, some more dramatic than others. How did the Section 8 payments follow suit? Are they just tied directly to CPI, or how is that managed as it relates to just market rents?
Yeah, I believe they are. The increases are either tied to CPI or localized rental appreciation rates in zip code. So if if you go to Dallas Housing Authority, DHA right now, you'll pull down the 2024 payment standards, and they're all done by zip code and by bedroom. And I think they do a very, very good job staying in tune with not just overall rent growth in Dallas, which is a big place, but localized rent growth in each individual zip code. And we've actually seen fluctuation there at the zip code level year over year.
Have you seen that the rates, the regular market rates to that of the Section 8 rates are typically, is Section 8 typically higher, assuming apples to apples comparison, three bedroom, two bath in a specific county. Do you get more for Section 8 or do you get more if you went the market rate?
You can probably squeeze a little bit more out on the market rate,
Okay.
right? At least up front. But you get one tenant in there or one resident, and you end up having to evict them for whatever reason. That extra margin to me isn't worth it.
Hmm.
And I'd much rather leave 100 or $150 a month on the table and
Yep.
get paid on time every time until the resident chooses to leave than have
Hmm.
any sort of, risk. To me, it's all about time and risk, right? I have a demanding W-2, I have a demanding family, and is that extra 100 or $150 a month worth the headache versus, path of least resistance
Right.
and consistency?
So you've pivoted to from single family to, it sounds like mostly multifamily. Is that where the primary focus is today?
Yes, I
Okay.
haven't bought a single family now in probably, 5 or 6 years.
Yeah, smart man. No, nothing wrong with single family. It's just there's a more efficient, I mean, to your point, just a more efficient way to spend your time, spend your resources. And I think, buying 10, 20, 100, 150, whatever it might be, units in one location than that of, that many spread out amongst multiple different counties, I think is a much more efficient way to do it. So what does your business model look like today in the multifamily space? Kind of what is, what's in your buy box, size wise? Have you been actively buying in the last couple of years with rates going up? Just what does the business look like today?
Yeah, great question. So we are actively buying. I'd say over the course of the last even up until this year, the last 4 years, we have acquired, a half dozen assets, maybe seven assets, typically in the 20 to 30 unit range,
Hmm.
right? We like them. They're less competitive than larger assets. We were traditionally looking for, value add type opportunities. That's changed a little bit, especially as of late, and I'll explain why. But we like to build clusters, right? So we have four assets in Arlington that are within a 3 mile radius of each other. We have two in Garland. We have three townhouses on the same block in Richardson, right? Like we like to build clusters. It makes for more efficient management, and you get to know the neighborhood and the tenant profile a lot better. Back in 2020, 2021, we were buying huge value adds. We bought, two assets next door to one another where the average rents were 600, $650 a month, and we're getting 1,300 a month now.
Oh my gosh.
But it took, $1 million in CapEx in order to drive those rent increases, right?
Hmm.
We would still look at a deal like that today, but, the purchase price would need to be that much juicier because the debt is that much more expensive, right?
Sure.
Plus, I don't think it's a very safe bet right now to bake in that serious an increase, that drastic an increase in rents
Yeah.
because of where we're at in the market cycle. So we've kind of strayed away from those very heavy lift value add assets. We acquired a deal, I don't know, 6 months ago, 7 months ago now. It's 80s product, needed minimal updating. We're turning units and putting a little bit more of a premium finish in with some paint and some granite countertops. And I think we're making a concerted effort right now to really move up into the 70 to 100 unit space, still in that, 80s plus vintage. We've just earlier this year, we had, two different underground plumbing leaks that were expensive for us to fix. So we're trying to stay in the 80s above where there's PVC as opposed to cast iron. We're
Hmm.
learning from our mistakes and adjusting. And quite frankly, if you look at the return profile of A, B, and C class assets, the return profile now, we're just seeing better returns on newer product because there's less CapEx and it's attracting a different demographic from a resident profile perspective. So
Yeah.
we've definitely learned over the last couple of years and evolved as recently as the last few months.
And what are you seeing out there today? I mean, are you seeing any, distress opportunities come to light? I mean, anything that you guys have made a run at or anything that you're close on?
You know, we have seen some quote unquote distressed deals.
Hmm.
But not the windfall that we were expecting to see in 2024. And I know we had a discussion earlier this year about this windfall of distressed assets that was coming in 2024. There has certainly been some. We've heard about a number of assets. We know some folks that have been, very well connected at the banking level that have gotten early looks at deals that were, in trouble pre-foreclosure, and we're able to gobble those up at a pretty significant to where those deals would trade on a fully marketed transaction today. We're definitely
Hmm.
keeping our eye out for distressed deals, but we're also looking for, you know, 2025, I think, is really going to be where the dirty water comes out. We're starting to hear about a lot of capital calls out there. We're
Hmm.
starting to hear about situations where lenders gave some extra runway on some deals and that runway is run out and folks are really they need to make a decision whether they're going to exit or just give the asset back now. So I think 2025 is going to be the year where we start to see more of those distressed opportunities, way more than what we've seen in 2024.
And any changes inside the organization? I agree with you. I agree with that sentiment. But are you making any shifts or any adjustments to just to the organization as a whole, to the capital raising strategies? I mean, obviously, when times are incredibly liquid, there was lots of capital flowing a couple of years back before your rates went up. Capital is readily available. I mean, deals are transacting, capital is readily available, but now not as many deals out there. Some distress in the marketplace, some uncertainty in the marketplace, a lot of it, quite a lot of uncertainty. Capital is very much harder to come by now. We found that quite a bit more difficult to raise capital in this environment. So anything that you guys have done internally or are planning to do in order to be able to capitalize whenever that windfall happens, whether it's 2024, 2025, 2026, at some point in time, there will be some distress that gets flushed out of the system. What are you guys going to do in order to capitalize on that?
Great question. So I think it's largely falls down into two buckets of relationships, right?
Mhm.
One is continuing to develop our relationships with brokers and staying in front of the lenders, right? The lenders know when deals are not performing well, and if we have relationships with those folks, maybe they can give us a look. Same thing with brokers, right? We're in touch with a number of fantastic brokers in this area, and they know to call us when they have something that is that fits our buy box. The other thing is the relationships with investors. I think I had a conversation with one of my mastermind colleagues earlier this year, and there's a difference between attracting capital and raising capital, right? And we've been making a concerted effort to attract capital so that when it's time to raise capital, it's probably going to be more challenging than it has been, but
Yeah.
we should still be able to execute. Now, what's the difference? Attracting capital is putting our brand out there, letting folks know that the deals that we have are performing, or and setting expectations on returns, distributions, the whole thing. Our podcast, a bunch of other kind of demand generation stuff that we're doing. We've also changed our strategy on following up on inbound inquiries to our website and having different types of conversations that we were having before. It's much less lock and load type fishing than it was a
Hmm.
few years ago, and it's definitely more, nibble and kind of pursue those types of investors. It's a different conversation now than it was before.
Yeah. No,
So I think those two things at a high level is really, what we've adjusted. And as a sales guy, right, to me, everything's a funnel. 2 years ago, 3 years ago, we could have a webcast and be fully subscribed before the end of the show or before the end of the webcast. Now, it definitely takes a little bit more work, but if you were dealing with a pool of 100 qualified investors then, now we need a pool of 200 investors, right? So how do we double our efforts on the top of the funnel and have great conversations with folks and really kind of qualify in, qualify out on both sides so that when we have an opportunity, they know who we are, we know who they are. There's
Hmm.
twice as many of the folks in that funnel, and then ultimately we can close on time.
Yeah, no, I agree, and I think investors are just they're becoming more educated, more sophisticated as time goes on. And I think it's a good thing. It's a good thing for all of us. Number one, I think as we've gone through some of these challenging times, as you had mentioned, there's multiple multifamily groups out there doing capital calls. There's quite a lot of that out there, and I think it's really pushing LPs to start diving a little deeper as to like what were wrong, what kind of questions could I have asked, 2 years ago when I got into this deal, so I could at least better understand the situation that we're in or the deal's in, because I think a lot of folks just went in very blindly, and so hopefully that's a little bit of a wake up call. Because I
Mhm.
think it makes everyone's life easier, right? From a GP side, obviously we can only hand the documentation over, the PPMs and the subscription agreements. We can only hand that over, but we can't force anyone to read it, understand it, or ask the right questions. We can answer questions when they're asked, but ultimately, we don't know where the blind spots might be. But what I have seen is that a lot of LPs are really diving in deeper in a more granular nature, which is good. That makes me feel so much better because ultimately we look at these things as long-term partnerships, right? And inevitably, there's always going to be some bumps along the road. Hopefully, not a bump that's as big as a capital call or a deal going south, but inevitably there's going to be bumps along the road. And knowing that all parties are very clear with what the trajectory looks like, what the business plan is, what happens when there are bumps, in the road. How do we work through these together rather than the uneducated or uninformed, probably uninformed is a better way to put it, investors that just signed a document. I got the money. I'm getting in this thing. I heard that a lot of people that invested with you made a lot of money a couple of years ago, and I'm
Yeah.
in for the ride. But I really don't know what the ride looks like, and I don't know which direction the ride could potentially go. So I think it's a good thing. You always have to go through a little bit of pain to actually grow on the other side, right? I think we're growing and we're becoming better investors because of it. So, um,
Yeah, I completely agree with that. And look, I think a couple things, right, on that point. Number one, I don't know if anyone could have seen what we've gone through in the last 18 months before it actually happened. With the amount of money that was pumped into the economy during COVID, everybody knew inflation was coming. I don't think anybody thought it was going to be as quick and as drastic as it was, and ultimately how the Fed reacted, right? Did we really know the impact of all this incoming supply? And then did we really know that, property taxes and insurance are two largest uncontrollable expenses we're going to skyrocket? And did we think that all of that was going to happen at the exact same time? And how was that going to kind of send our business plan sideways? So I think there's been a lot of that, but I also think that retrospectively, what we've seen is that there were folks that were operators and folks that were marketers, right?
mhm. Yep.
And like we self-managed a bunch of our assets for a while. Just a few weeks ago, like I went door knocking on a Saturday afternoon to help collect rent with our property management team. Like we are super hands-on, and I think that shows in the performance of our assets. And I would just say that, yeah, any LPs that looking to, invest money, much like you said, Kevin, like get educated, ask hard questions, qualify out more than you qualify in, and figure out what works best for you and how confident you are in the jockey, not the horse.
Yep. No, no, all great points there. Incredibly important. Matt, before we wrap this up here, I like to round it out, with having you share a story with us. You've been at this long enough now, been at it 8 years. You bought lots of different types of real estate. Is there a deal that comes to mind, right? Like there's always that one deal, maybe more than one. If you're in it long enough, it's always more than one, that just was inherently challenging. You lost sleep, gave you extra gray hairs, just it gave you an undue amount of stress. And whether you closed the deal or you did, maybe you decide not to buy it, but just, I guess, does anything come to mind when I say that? And if so, what was the deal? What were the challenges? Did you push through? If so, what did it look like on the other side? Or did you decide to kill it and move on to the next one? Is there anything that comes to mind that you might share with us?
Absolutely. So the first multifamily deal that we ever did was an 8 unit in Arlington, 60s vintage. I made a blind offer on it. Got declined. They circled back with me, I don't know, a month later. The buyer dropped out. They gave me a second look. I was, talking to my partner or talking to my friend Mike about potentially doing a deal together. Mike's my co-founder in Take Flyte Properties. We partnered up on it. So immediately we're figuring out how we work together. And, he's an engineer by trade. I'm a sales guy. And it was like opposing disc profiles on a conference call for hours every night. We ultimately closed on the deal. We had a hoarder in one unit. The day we closed, one of the units got evicted. A third, this is an 8 unit, by the way. So like you're talking 2 or 3 units, it's a significant portion of the
Sure.
population. The third unit was the cousin of the guy who owned it. So as soon as he found out that the gravy train of free rent was over, he moved out. So like within a week of closing, we had, 2 vacant units and we had to deal with a hoarder. And it was terrible in there. We also hired this handyman that gave us a great price on doing all the rehab. And, he turned out to be an alcoholic. So, a 3 month project turned into a 6 or 7 month turn. We had materials that we were ordering on our own and orchestrating deliveries with Lowe's. It was just everything that could go wrong did. But we bought that asset for, I don't know, $45,000 a door and sold it for $90,000 a door 3.5 years later. We raised rents on it. I think it was a total, 300% return. And we learned all about the things that we would want to do again and things that we wouldn't want to do again. I think I was driving from my house out to Arlington, which is an hour plus each way, a couple times a week. Mike was driving back, through Arlington on his way back from Fort Worth a couple times a week. We were just like super hands-on. I think everyone who invests needs to have an experience like that because, you know, you're going to be measured on how you handle hard times, not how you handle easy times. And
That's right.
unless you know how to get through those types of things, it's in it, but especially before you try and scale, you
Hmm.
kill the dragon when it's small, learn from when the dragon's small because bigger problems are bigger costs.
No, that's great. I appreciate you sharing that. Yeah, no, it's call that a seminar in a box.
Yeah,
Yeah, no, yeah, you have to have those, and inevitably, hopefully, down the road they're not as bad, but ultimately you'll probably have similar challenges other times. You just know how to handle them better now, right? You handle more efficiently. You've been down that road before. You can maybe even, cut them off before they grow into as large of a problem as they were last time, right? You kind of identify the problem ahead of time and cut it off before it grows into a virus. No, but I appreciate you sharing that. Appreciate the vulnerability there. We all have those challenges. If you've been at this long enough, you'll have those challenging deals. If you haven't had one of those yet, you just haven't done enough transactions. So
good point.
it'll inevitably come. Matt, for those that want to learn more about you and your organization, your group, where's the best place to find you?
Yeah, you can find me anywhere. I'm on Facebook, I'm on Instagram, I'm on LinkedIn. Feel free to find me anywhere. Give me a connection request. You can also find me at deepbluere.com. That's our website for Deep Blue Capital. You can also find me at ownwell.com. That is the company I work for right now as head of sales and commercial property tax appeals. I'm all over the place and shouldn't be hard to find. I welcome any connections. Any one of your listeners can send me an email to matt@ownwell.com and I'd be happy to have a conversation with them.
Awesome. I appreciate it, Matt, and thank you for coming on the show.
Thanks so much for having me, Kevin. This was awesome.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.